Imagine two retirees with exactly the same income. One of them pays almost no tax at all. The other one writes checks to Revenue Canada like it's some kind of subscription service. And they have to pay next year's tax in advance. Same country, same tax law, same investment opportunities. The difference is not how much they make, it's where the income comes from. And stay with me because later in the video, I'm going to tell you how some retirees can collect their government pensions and make another $30,000 a year without paying hardly any tax at all. When people think about investment income, they often think only about the returns. But it's more than that. It's where that income comes from and how it's taxed and what you're left with after you pay the taxes. Taxes are like an invisible headwind that you might not notice until it's too late. I've seen many people scramble to pay their taxes because they've already spent everything they earned for the year. And this can especially hit retirees hard because they usually don't have tax withheld from their income the way someone who has a job does. Today, we'll be talking about how different types of investment income are taxed differently and why that can make all the difference. The least tax-friendly source of income is interest, whether it's on a bank account, a GIC, a bond, because interest is taxed at your full marginal rate. There's no discounts, there's no additional tax credits for it. Whatever you earn, you pay taxes on. It is very safe, but it's not very tax-friendly. And let's face it, the interest rates paid on most investments these days don't even keep up with inflation. Now, if you need cash short term, and I keep about 6 months of expenses on hand, it's okay to put that in something that isn't going to earn that much interest because it's always going to be available to you. But if you've got money to put away longer term, it's best to find something else. Capital gains get much better tax treatment. On a capital gain, you only pay tax on half the gain. Now, a capital gain is when you buy something like an investment property or a stock, and then you sell it for more than you paid for it. So if you, for example, made $10,000 on a stock, you would pay tax on only 5,000 of that. Not 5,000 of tax on only 5,000. It's like the first 5,000 was never made. Now, the other thing about capital gains is that you control when you pay tax on it. You do not pay tax until you sell it. So if you've got a stock that has tripled in value since you purchased it, but you're still owning it, there is no tax to pay on that. So you've got a lower tax rate and a lot of control. Next up, dividends. Dividends are the quiet gem of investments. In Canada, this is especially true of what they call eligible Canadian dividends. These are dividends that you are paid from a large corporation. Now, a large corporation pays a different tax rate than a small corporation. And when they pay you the dividend, they do not get a tax deduction for it. They still pay the tax, even though that dividend winds up in your bank account. Now, when you report the income, it's grossed up. So if you earn $100, say, on a dividend, you have to report $138 on your tax return. Doesn't sound good so far, does it? Well, here's where the advantage comes. You get a tax credit federally and provincially for the tax that the corporation paid. In fact, if you make nothing but dividends, you can make about $30,000 without paying any tax or very, very little. Now, I'll circle back around to this when we talk about the different ways to hold investments. If this video is helping you to think a little bit differently about your retirement income or your investment income, even if you're not retired, please consider giving the video a thumbs up for me. And if you'd like some information and help on this kind of thing every week, hit subscribe and don't forget to tap the notification bell so you don't miss a thing. Now, Let's look at how the same investment in different accounts will affect your tax rates. First, let's think about RRSPs, Registered Retirement Savings Plans. In other countries, you probably have other investment vehicles such as a 401k, an individual retirement account, that kind of thing. What happens is you get a tax deduction when you make the contribution. So let's say you contribute $1,000. You get a tax deduction on your income tax return and you don't pay any tax on that income. However, when you cash that in and begin collecting it in retirement, you are going to pay tax on the full amount. So if that $1,000 becomes $2,000 and you take it out, that $2,000 hits your tax return. It doesn't matter whether it's a dividend, a capital gain, or interest, it's all taxed at the same rate. With one little addition to that, in Canada, if you're over 65, you can take out $2,000 a year tax-free. You get an offsetting credit to look after that, but full tax on anything after that. And one hidden danger here, if you're taking an awful lot out of your RRSP, is it can affect your old age security. If your income rises above a certain level, the government starts clawing back a portion of your old age security. If it rises too high, they simply take it all back. Not sounding good, but let's face it, if you're making that much money, you probably don't need the old age security anyways, as it was designed to help low income people. Now, a tax-free savings account works differently still. With a tax-free savings account, the counterpart would be a Roth IRA. I know England has the same kind of plan. You do not get a tax deduction when you make the contribution. However, whatever it earns inside the TFSA is tax-free forever. So let's say you buy a stock for $1,000. It quintuples in value. It's now worth $5,000. You cash it in, you take it out of your tax-free savings account. It doesn't even get reported on your tax return. It is tax-free. Now let's talk about a cash or a non-registered account. So this account gets no special tax advantage at all. There's no deduction when it goes in, and you pay tax on anything that comes out. Now, if it's capital gains, you're going to pay 50% up to the first 250,000. If it's interest, you're going to pay it at the full marginal rate. This, though, is where dividends really shine. Remember that dividend tax credit you get for the tax that the corporation paid on your behalf? Well, that will offset almost $30,000 of income every year. So, for example, let's say that dividends are your only source of income. You might at the most pay a few $100s of provincial tax. If you're in retirement and you qualify for the age amount, you're over 65, you can get your Canada pension and your old age security. The tax on those pensions is almost entirely wiped out by your basic amount and your age credit. Now, it might offset all of it, most of it, or more than all of it. But when you add 30,000 dividends on top of that, your dividend tax credits cover that tax, and you're paying very little to no tax on CPP plus OAS plus 30,000 of dividends. Not a bad deal. Now, if you're holding foreign investments in any of those accounts, there's a couple of things you have to keep in mind. First of all, in an RRSP, you're generally exempt from paying foreign taxes. In a tax-free savings account, taxes are going to be withheld and you've got no way of recovering them. If you own foreign investments in a cash account, again, they're going to withhold taxes, but in some cases, you can claim all of that or some of it back on your personal income tax return. Because of that disadvantage of owning a foreign investment in a tax-free savings account, generally I avoid them unless they're going to pay a super high dividend that more than offsets that 15% tax I'm going to lose. If this is sounding a little complicated, you might want to get some advice from a financial advisor or your accountant. So this is how those two retirees I mentioned at the beginning of the video pay different amounts of tax on the same amount of income. One focuses only on returns, The other focuses on what's left after any taxes have to be paid. Now, this is part of the financial engine side of your retirement planning. Believe me, I don't find tax interesting at all, but I think it's important to understand the basics or to be working with someone that does so that you don't pay any more tax than you have to. Not flashy, not exciting, but very important to know. Thanks for watching. I'll see you next time. And until then, consider these next videos. You might find them helpful.